Is the American wealth boom a blessing or an illusion?
It's a pressing question. Join George Gammon, David Lynn, and more as they break it down.
In this compilation, we've distilled their extensive insights into quick, actionable summaries.
Stay tuned as we dive deep into what these trends mean for your investments and economic future.
Today, we're examining George Gammon's insights on America's wealth boom in light of inflation and economic principles.
George highlights that owning assets, particularly in an inflationary environment, can increase purchasing power.
George argues that measuring wealth purely in currency terms ignores the reality of goods and services availability.
He stresses that an increase in currency does not necessarily equate to improved wealth for society. George mentions that many Americans may feel richer as asset prices like homes or stocks rise more than inflation.
This creates an illusion of increased purchasing power, even as living costs also rise. According to George, meaningful economic progress is tied to productivity improvements that should result in lower prices.
He emphasizes that merely raising wages without enhancing productivity is misguided. George asserts that the true essence of the American dream is about access to affordable goods that elevate quality of life.
He calls for a redefinition of wealth that prioritizes access to resources and productivity. Looking ahead, George foresees that without productivity increases, asset prices may face significant pressures.
He advises focusing on productivity investments to improve wealth equity.
In conclusion, George highlights the need for a transformation in how we view economic policies to prioritize productivity.
This reevaluation is vital to improve the standard of living for all, not just the wealthy.
Welcome to today's market review, where we analyze the insights shared by David Lynn regarding the current state of the equity markets and what we can expect in the coming weeks.
David emphasizes the significance of the do or die zone for the S&P, indicating crucial levels to watch as we assess market volatility.
David Lynn suggests that the upcoming CPI data will be pivotal for market direction, with volatility expected.
He underscores the necessity of closely monitoring these economic indicators to anticipate potential corrections in the market.
According to David, the market's recent behavior indicates a bearish phase as we approach significant support levels.
He warns that breaking below these key levels could trigger a more profound sell-off.
David anticipates that the upcoming CPI print will significantly influence investor sentiment moving forward.
He notes that any surprises in the data could heighten market volatility.
Looking ahead, David predicts that if markets do not stabilize soon, we may see a potential correction of up to 7%.
He emphasizes that monitoring inflation metrics will be essential for understanding the Fed's potential responses.
David concludes that investors must remain vigilant and be prepared to adjust their strategies as market conditions change.
It's crucial to monitor support levels to anticipate corrections, ensuring a well-informed trading approach.
Today, we're diving into insights from Mitch Vexler regarding the alarming job cuts reported in February and the implications for the housing market.
Mitch Vexler highlights that while the economy reportedly added jobs, we actually lost over 862,000 full-time positions.
According to Mitch Vexler, the significant discrepancy between the establishment survey and the household survey raises critical questions about the accuracy of job growth claims.
Mitch emphasizes that while the establishment survey reported a rise in jobs, the household survey revealed substantial job losses, particularly in full-time positions.
Mitch points out that the rise in part-time jobs reflects the necessity for families to take on multiple roles to make ends meet.
This trend signifies growing economic distress as more people are forced into part-time roles instead of steady full-time employment. Mitch discusses the alarming trend in the housing market, indicating that pending home sales have decreased significantly, reflecting buyers' hesitance due to high mortgage costs.
He suggests that despite slight dips in mortgage rates, overall economic uncertainty is keeping buyers cautious. What does Mitch predict for the future of the housing market?
Mitch suggests that without addressing the underlying issues in the economy, we may see a prolonged downturn in housing prices.
To summarize, Mitch Vexler encourages viewers to rely on local market analysis rather than national trends to understand the housing situation.
He emphasizes that families need to rethink their financial strategies in light of rising economic pressures.
We're delving into the current issues in global trade, as highlighted by Jeff Snider.
Jeff warns that while imports are high, this may signify deeper economic weaknesses.
Jeff Snider warns that the surge in imports could signify an upcoming payback period.
He notes that classic recession signals are affecting stock investor sentiment.
Jeff asserts that the increase in imports does not signify economic health, but represents an alarming risk.
He also points out that businesses attempt to inflate sales prices to recover mounting import costs.
According to Jeff, retailers are accumulating inventory in hopes of selling at higher prices after tariffs.
However, this strategy may fail if consumer demand falters.
Jeff discusses how declining Chinese imports signal potential issues for the global economy.
He emphasizes that China's exports are a crucial component in the economic cycle, and their slowdown is concerning.
What predictions does Jeff have for market conditions approaching 2025?
Jeff foresees major market corrections if current trends persist.
Jeff concludes that businesses need to rethink their inventory practices to prevent significant losses.
Investors must remain vigilant and ready for potential market pitfalls as economic indicators evolve.
Today, we're reviewing the important market updates shared by David Lin regarding the ongoing challenges within the equity markets.
David emphasizes the significant panic selling observed in recent trading sessions.
David Lin points out that ongoing panic selling has significantly altered market sentiment.
He mentions that the rising VIX indicates increased fear among investors.
David highlights the critical role the Magnificent Seven play in determining market direction.
He suggests their recent loss of momentum could indicate trouble for overall market health.
According to David, a potential cycle low is forming in the current market.
He cautions that bear flags might indicate further market declines.
David notes that many investors are flocking to bonds as a safer investment alternative.
He observes that bonds are showing upward momentum amidst market volatility.
What does David predict about future market movements?
He anticipates a potential rebound, but stresses that the longer-term outlook for equities remains bearish.
David advises traders to remain cautious given the current market instability.
He emphasizes the importance of keeping an eye on the Magnificent Seven for future market guidance.
Today, we're examining the fiscal challenges facing the U.S. economy, as discussed by economist Dr. Judy Shelton.
Dr. Shelton highlights the urgent need for reforms to address our unsustainable fiscal path.
Dr. Shelton warns that the U.S. has hit a turning point regarding its national debt.
She stresses that we are now facing a day one situation where immediate action is required.
What grade does Dr. Shelton give the Federal Reserve for its monetary policies?
Dr. Shelton gives the Fed a D, criticizing its lack of effective measures against inflation.
What changes does Dr. Shelton suggest for reducing the national debt?
Dr. Shelton calls for a commitment to fiscal responsibility and budget cuts.
How does Dr. Shelton envision the implementation of gold-backed bonds?
Dr. Shelton suggests that these bonds could restore trust in the currency and stabilize the economy.
What outcomes does Dr. Shelton predict if sound money policies are adopted?
She predicts significant economic growth and stability if implemented correctly.
Dr. Shelton concludes by urging policymakers to take bold steps towards fiscal sustainability.
She emphasizes that a return to sound money principles is vital for the future.
Wow, we've covered quite a spectrum of insights today.
Indeed, each expert brought something unique, from Dr. Shelton's call for fiscal reform to David Lin's observations on market volatility.
It was intriguing how they all recognized the significant challenges facing the economy today.
Absolutely. Yet, interestingly, there's this debate on how to overcome these challenges, or if they can be overcome at all.
Right, like Dr. Shelton and George Gammon, for instance. Dr. Shelton is waving the flag for drastic reforms, while Gammon is questioning the currency-centric wealth definition.
And then there's David Lin highlighting the panic in equity markets, suggesting a need for defensive strategies.
Which perfectly ties with Jeff Snider's assertion of imports signaling economic weakness. So many threads to follow.
Exactly. It's a complex web of perspectives and passive signals. Definitely food for thought.
For everyone watching, if you found these insights valuable, don't forget to give us a like and subscribe.
Your support fuels our mission of delivering more top-tier expert analyses directly to you.
And stay tuned for our next episode where we'll dissect global trade dynamics. a hot topic with a lot at stake.
You won't want to miss it. Until next time, keep questioning and stay informed.